Right. So starting out with your CFA Level 3 content for August 2026. And the first thing I want to talk about is that in Level 3, the pass rates are a lot higher as compared to the pass rates at 1 and 2. While there was a drop in the pass rates ever since the exam went on the computer-based testing, but I don't think that's reflective of the computer-based testing format. I think that drop happened also because of the time it coincided with COVID. But the pass rates ever since have jumped back up and have got again to the normal range of around 50% or so. This odd year of 76%, this is an odd year that doesn't happen often. But the pass rates are, going to range around 50 to 55%. That means a majority of candidates actually clear. Last year in February and August, we had a very good pass rate. Our batches were almost about 15-20 candidates, and almost about 70-75% of the candidates for our classes cleared, which is pretty encouraging. So I felt good about that. But of course, the pass rates for every batch, every candidate depends on the effort and time you guys put in. And of course, I'm there to answer your questions, queries, and support you. But at the end of the day, it totally depends on your effort and time. The format of the exam at Level 3 is very different. It's very different from the 1 and 2 completely. In Level 1, it's completely multiple choice. In Level 2, it's half multiple choice and half, in fact, it's full multiple choice, just that you have case stats being provided. The way Level 3 is different is that you will have 2 exams of 2 hours, 12 minutes each. And you will have a set of 11 questions each. 11 questions each in the first half and 11 questions in the second half. The breakup will be 5 to 6 or 6 to 5, where you will have 6 item sets and 5 essay questions, or 5 item sets or 6 essay questions. In total, you will have 11 item sets and 11 essay questions. Item sets mean that you will have a paragraph followed by 4 questions of multiple choice questions each, 3 choices, no negative marking, just the way you did at Level 2. But at the other 11 questions will be essay type questions, where there will be written questions where you will have to attempt and write down your answers. Now, I completely recognize that candidates find this part of the Level 3 content to be very challenging. And I believe that, yes, Level 3 essay type is definitely a part which can create challenges for candidates. But there are important lessons to be learned here. And one of the first lessons to be understood is that the average score in the essay part of the exam for most candidates does not rise beyond 65%. So even a candidate who scores like a 90th percentile does not get like a 70% on the essay part. So don't be too worried about that. But what is very, very critical in the Level 3 exam is that the 44 questions that you get, which are the multiple choice questions, that you have to have a very high accuracy with. If you're getting 44 questions as multiple choice questions, you almost have to have an 85% accuracy on that, where your score needs to be around 37, 38 questions from there. That means you really cannot make a mistake in the multiple choice questions. And the balance, the essay type questions, even if you get a 60%, it's okay. So the first thing that you have to recognize is that take off the pressure from the essay type questions. Don't be too worried about it. Candidates who gave the exam right now in February and January 2026 came back and said that the exam was a lot tough. I mean, most candidates complained that the exam was tough. Most of the candidates I spoke to, they were complaining that the exam was a lot tougher than they expected. But that's okay. I mean, if it's tough for one, it's tough for everybody. One good thing that has happened in Level 3 is that the exam format, which is a new format, which is a mixture of essay and multiple choice questions, allow you to complete the exam completely. That means that completing the exam is usually not a challenge. All the candidates I spoke to, most candidates said that they were barely able to just complete the entire exam 5 minutes or 10 minutes early, not like well before that. Because the essay type questions do take time. You have to read the essay, framing your sentences takes time to that. So that part is a little challenging. However, essay type does not mean that you have to write long answers. This is one point which is very, very important for Indian candidates. Unlike how you have attempted your college, school examinations, you do not have to put out your points in detail and write long answers. No, not at all. That's not something that you got to do at level 3. You are very well okay to write answers in bullet points. Short bullet points to the T is perfectly fine. In fact, questions which are numerical questions may not even ask you to show your calculations. They may completely only ask you for the final answer. And if you write the final answer, you will get final points, total points, full. So if it's like, for example, the question says how many future contracts are required to change the exposure of the portfolio from so and so, and you do the calculation on a rough sheet and write the final answer that says, okay, 325 contracts are required, long position, done. That's it. You don't have to even sometimes show your calculations. So don't think that essay type questions require you to write a lot. That's one point I want to make it very clear. Also, you don't need to write equations on the exam. So the math editor function of writing equations is also not there. So you don't have to sort of formulate equations and write, no, not required. A part of the multiple choice, a part of the essay part questions are also multiple choice, by the way. Questions of the examination very often are structured as they give you the question. For example, the question could be, they would give you a case and they give you the 3 asset allocations and say, here are the asset allocations that we would probably choose from. So they would ask you to choose which asset allocation is the most appropriate for the client. That part is a multiple choice, and then you have to justify. So the question might be, let's say, of 4 points. And out of the 4 points, 1 point would be to choose and 3 points would be to explain. The rule of thumb at level 3 works as 1 bullet point for 2 points. So if you write 1 bullet point, that is a 2-mark point. So that's the trade-off that you're looking at. So if it's a 4-mark question, you need 2 bullet points for that. If it's a 3-mark question, again, 2 bullet points would serve. So work with a rule of thumb of approximately 1 bullet point for every 1.5 to 2-mark question that you need. Okay. Another very important point in level 3 is, and this is important for Indian candidates, very specifically so, because we are in the habit of writing a lot more than what is needed. If the question asks for, give us 2 reasons for something. Now you are wanting to take your bet, यार नहीं आता पूरा, चलो कोई बात नहीं, जो आता है वो तो लिख दो. तो आपने 5 रीजन लिख दिए, आपने पूछे 2 थे, कम से कम कुछ तो सही होगा. तो फर्स्ट सिर्फ आपके पहले 2 चेक करेगा, वो 5 नहीं चेक करेगा. तो अगर आपने 5 लिखे हैं तो आपके 3rd, 4th, 5th मैटर नहीं करते उसको. सो ज्यादा लिखने का कोई सेंस नहीं है. So you need to write only as much as is being asked on the examination, nothing more than that. So as far as the length of the exam is concerned, it's not as much of a concern in that case then. Very rarely do candidates now complain that they were unable to complete the paper. In the past, that was always the case. Example, candidates weren't able to complete the level 3 exam earlier. Even in my case, when I gave level 3 exam many years ago, I wasn't able to complete the exam. But that was how everybody was. But now today, the exam, you can complete within the time that is available. So that's the advantage of it. So that's the first segment of my discussion. The second part of discussion is about the content. At level 3, the content is very, very different from 1 and 2. At level 3, the content is very dry. For lack of a better word, it is dry. It's not as engaging, as interesting, as amazing as maybe as what you think at level 1 and 2 is. The reason for that is that you are not going to look at very specific formulas or derivations or calculations to give you specific answers of overvalued, undervalued securities. No, that part is over. The one very important principle at level 3 that you have to keep in mind at all times is that you are a financial advisor. You are in the position of an advisor. You are helping a client to choose which portfolio managers, which asset classes to invest in. So your goal is that as a very top-down investor, where you're looking at a very broad focus of things. A significant part of level 3 content discussion goes into passive investing, of how do you get the beta exposure. That may sound like a very simplistic point that, oh, just getting beta exposure is simply to replicate the benchmark, but it's not that straightforward. In the subject of, here in LM1 and LM2, in the topic of fixed income and equity, you'll only be talking about those areas. So these areas, you'll talk about only the equity and portfolio management in passive investing. In fact, for the guys who choose the portfolio management pathway, this will be a major area of discussion. Okay. Some of the common questions asked here by candidates are that, oh, I gave level 1 and 2 many years ago. I don't remember anything. Or say, for example, I was weak in this subject, I was strong in that subject, blah, blah, blah. Simple answer to all of that is you don't need your level 1 and 2 books. Whatever answers you need to get through, you'll get at level 3. Some of the basics that you will definitely need, yes, you can't do without. You can't do without the basics of derivatives. That is, sorry, one thing you have to get. Basics. Basics means you can't say, sorry, I don't know what's a call option, a put option, a forward contract, a swap contract, an option contract. Basics you can't say no to. And I'm guessing by reaching here, you can't have said that, oh, I haven't done any bit of options or derivatives. Basics need to be done because we have to build upon that and do little more detailed strategies. And if you are choosing the portfolio management pathway, then you also need to look at a little bit of fixed income. You need to know what is duration, convexity, key rate duration, some basic concepts you need to know. But if you're not taking that, if you're not taking the topic on portfolio management, then that fixed income is also not required. There is no quant. There is no financial statement analysis. There is no corporate issuers at level 3. So those topics get completely moved out. So no regression analysis, no accounting, no corporate issuers. So those parts are absolutely not there. And ethics at level 3 is again almost identical to the ethics at level 1 and 2. So the content at 1 and 2 gets almost repeated here again. And it can again be a make or a break, just like it has been in 1 and 2. So you can't ignore it. You can't take it for an easy way. This core part of your readings comprise of almost 3/4 of the entire content. So you will get a majority of questions from here. And then the balance of the content, which is your specialized area, you will get about 30% of the content from there, 1/3. These are the readings. Every topic has 7 readings each. And if you have registered for the August exam, I believe you should have already chosen these topic areas. You would have chosen which area you're specializing in. But if you haven't, I'm happy to have a discussion today to help you make a choice in terms of which pathway covers what kind of content. From the classes perspective, I have mentioned I'll cover all 3 for you one by one. I'll take one pathway, complete that, move to the next pathway and complete that, and so on and so forth. And hopefully by early June or so, I'll be able to complete all the content with you in the class. The idea of attending classes here is to help you maintain regularity, to help you give some sense of support, and to answer your questions as we go along. In my classes here, I will use the CFA core books as the reference point of content. So I'll open up, this is exactly the way that my class is going to run, where I'll have the slides on one side and the book on the other side. And I'll then have content that's been highlighted in the book based on things that I saw relevant and important. I'll talk about that as we go along. Most of that relevant content that I found interesting and relevant from the book, I have put it out on the slides here too. So we'll use that as a reference and cover that as you go along. Okay. $1 million question. Everybody asks, which books? CFA books, Swedger books? Use what you like. I prefer the CFA books, but it's okay. If you wish to use the Swedger books, it's fine. But as you always know my way of going about, you must do the questions of the CFA book for sure. That's not you cannot say no to that. You have to practice questions on the CFA book. In fact, the problem, one of the issues in CFA level 3 is that there aren't many questions and practice mocks available. So that creates one bit of a challenge. And any mock created by third party is very often not a representative of the exam either. So the best place to do questions from is, of course, the CFA website, the learning ecosystem, and their past mocks and the mock exams that they provided. At level 3, one extra thing that is usually provided is some sample papers from the past. So we have access to some of the past papers that the CFA Institute has provided. I'll share those with you also. Although they are old, so they are not very relevant, but they give you a structure of the kind of questions that CFA Institute does ask. So it'll give you an idea of the kind of questions, the kind of answers that you're supposed to write. As far as the length of content is concerned at level 3, it is the shortest. Among the 3 levels, level 3 is the shortest of the 3. So it doesn't take that long to cover the content. As you can clearly see, the number of classes or the time duration of our classes is way shorter than 1 and 2. At 3, our classes are only 2 hours each, and the time period otherwise is the same in terms of the number of months. So you will see that the number of classes that it takes or the number of hours it takes to cover the content is lesser as compared to 1 and 2. And even if you've had a booklet, if you've received it, you will find that it is thinner as compared to 1 and 2 again. So is level 3 doable from now till August? The simple answer to that is absolutely yes. It's for you to make it doable. And to put in that effort, time and energy right now. If you can put in the time and effort right now, you can get it done. March, April, May, June, July. Wow, that's plenty of time for the level 3. As far as the rigor of the content is concerned, it's not that rigorous. I told you it's a little dry. And after reading a chapter or reading a topic and reading a learning module, you'll very often wonder कि करना क्या है. So बहुत top down, broad level discussion की जाती है. और I am happy to engage in those discussions with you here in class to give you that practice as well. So feel free to unmute your mic at any stage and ask questions. Just raise a hand so that I know you would like to have a question or just a chat. So do that and I'd be happy to discuss with you. Any questions, queries that you have? So my pointers that I had in my mind, I've said most of it with you. Any questions, queries that you have about the level 3 prep course, classes? Go ahead, ask now, and then we can potentially start as well. Yes, any questions? Yes, go ahead, Dipinder.
सर फेब 27 के लिए पूछना था, जैसे अगर आपके पास थोड़ी गाइडेंस वगैरह हो कि सिलेबस चेंज होगा या नहीं होगा, और
लेवल
कि
3
अभी से ही
में
स्टार्ट करना कैसा
लेवल
रहेगा।
3 में जो हमने CFA इंस्टीट्यूट से पूछा है, February 27 का कोर्स बहुत ज्यादा चेंज नहीं है, कोई मैसिव चेंज नहीं है। सो लेवल 1 में चेंज है, लेवल 2 और 3 में अगले साल बहुत ज्यादा कोई मैसिव चेंज नहीं है, अगर है तो माइनर चेंजेस होंगे, रीडिंग्स में कोई चेंज नहीं है। That much information we have. So now it depends on you as to how do you want to start. Do you want to start now or do you want to start later? That's a choice you have to make.
Okay,
Yeah.
sir. Thank you.
Yes, Danish.
Just wanted to confirm that are there any changes from like 2025 to 26?
No.
Okay.
None. Not at all. Not even a chapter or a page.
Perfect. Thank you.
Hi, sir.
Hi, Ritik.
So, sir, I just wanted to ask, it's a subject-related question. So, regarding ethics, so in the essay-related questions for ethics, like, do we
You
have
will
to
not have
write?
essay-related questions in ethics.
Okay, I just had
Ethics
that.
will only be tested in multiple choice.
Okay.
Yeah. Ethics will only be tested in multiple choice questions. There'll be no written questions on ethics. Yeah.
Hi, sir.
Hi, Suti.
Sir, another thing, like, I mean, though it's very subjective, but then how long does it take in entirety for one to prepare for level 3? I mean, how many hours? Or just to get a rough idea. If
4
you have to
5
plan
months.
it.
5 months at best. 4 5 months is a very good time. If you put in 4 5 months of time for the exam, you are good.
And how many hours a day? I mean, 4 5 months could
2
be
3
like a lot.
hours. Start with 2 hours a day. So they start with 2 hours a day and then scale it up as you go along. So the way you can do it is, the first thing that we need to do is we need to start getting into the habit of studying, the habit of hitting with the books and getting the content covered. So don't kill yourself with 6 hours a day or 3 hours a day or 4 hours a day. Start with 1.5 2 hours a day. Start with that. And with the target in mind that if you're sitting in February today, so March, April, end of May, max, you should have covered the course once. So give yourself 2.5 months from today. So March, April, mid-May, and try to cover out the entire course by that time. Now, based on how you are covering the course, pace yourself accordingly. If you are, for example, with the 2 hours, 2.5 hours of prep every day, you're able to cover the content, great. If not, then increase the number of hours as you go further. So start with 2 hours a day, and then, because 2 hours, I don't think sound a lot to begin with. And I think they feel doable. You feel that, oh, I can manage that. Most of the candidates say that. And then you increase the hours based on how things move.
Thank you.
Yeah. Ishan, I'm reading your question. If I'm planning to take the exam in August, by when should I start giving the mocks and complete the overall revision and run through? Mocks is somewhere, I think you will start in July. Because the examination in August, I'm looking at the dates, is from 13th to the 17th of August. So 13th to the 17th of August in 2026 is when your exam will happen. So you should ideally look at starting out early July or mid-July at latest to give a mock, so that you give yourself around 30-35 days for reviewing yourself and going back to the problems that you face. That means that by July, you should have covered the course twice. First run through of the course by around end of April, early May. So mid-May, let's put a date of mid-May. And then remaining part of May and June and a bit of July can be your second run through. So 2 run throughs are needed on the content before you can start doing a mock test. So mock test 2 months. So before you do the mock, 2 run throughs of the content are needed. That's the important part, because 1 run through is just familiarity. Second run through gives you the point that yes, now I have both clarity on the content. I have some bit of recallability also, and it's through the mock test that the clarity gets better and the mock tests can be done. Okay. Yes, more questions. Anything else? Really? You guys are a good lot. No questions. Wow. Anything related to the content? Anything related to the pathways? Have you all chosen the pathway which you would like to look at? Yes. How to select the pathway? Yes. So the pathway, 1 second. Yes. So I'm just sharing I'm sharing a poll on your accounts. You can just answer that. Just give me a moment. Yes. So I'm just giving you a poll and asking you which pathway have you selected, so that we know where are you on the topic, and then we can decide that. That's really amazing. So I can see the poll results. I'm not sure if you can see them or not. So a majority of the candidates, most of you have chosen private markets. And that's so amazing that CFA Institute, I'm sure never would have realized that how private markets is becoming so popular as a choice. Even in our previous batch, that is just for the February 26 exam, most of the candidates had chosen private markets and portfolio management. Like it was like a 50-50 breakup. But now the way I see it is that around 13 of you have answered the poll. So out of that, 5 of you have taken private markets. 1 of you has taken private wealth. 2 of you have taken portfolio management. 5 of you haven't decided yet. So which is okay. Now, how do you decide a pathway? So that's the question that came in. The way I see it is the way to choose a pathway is based on your area of interest. All the 3 pathways are very well written. Yes, the portfolio management pathway was the traditional pathway, but that's not the point anymore, because there's plenty of content for all 3 now. CFA Institute, by the way, now for the first time also provides premium questions for the level 3 material. That was not available previously. For the first time for the August examination, the CFA Institute provides premium pack questions too. And questions are available for all of them. Now, the choice between the 3 pathways should ideally be based on your area of interest or your area of current work experience. The reason I say that is because if you already have an experience in a certain sector, the ability for you to understand, ability for you to write answers or to grasp content will be the fastest. As far as the 3 pathways are concerned for in terms of level of rigor or challenge, portfolio management is probably the most challenging, the traditional pathway, followed by private markets and private wealth. The private markets and private wealth are a lot easier. Private wealth, in my opinion, being the easiest of the 3. Private market still has a bit of calculation and stuff. However, private markets isn't that challenging either. Private markets actually covers details related to topic on private equity, private debt, real estate, infrastructure, and even venture cap. So those are the areas it focuses on. Whereas private wealth focuses on individual and family wealth management. So as you can see the readings and see the title of the readings, wealth planning, investment planning, preserving the wealth, advising the wealth, and transferring of wealth. These are the areas that private wealth works on. So if you are already in the wealth management space, then probably this is something that you can pick on. Okay. Ishan, I'm reading your question. I haven't registered for the August exam yet. Since the window is open until May, could there be any seat availability issues if I want? Not at all. Not at all. There is no problem on that. Yeah. So no problem on the seat availability that you will think that, oh, the seats are not available. That's never an issue. So you can register to the last date. No problem with that. Right. So as far as the pathways are concerned, pick the pathway based on your background. And if you don't have a background on anything, then of course it's a matter of choice. Then don't, I mean, see, I disagree with this idea that a lot of people have, put up videos and said that pick the portfolio management pathway. It is the traditional pathway, the area that was already there. I don't agree with that. The reason I don't agree with that way of thinking is because I feel the CFA Institute cannot be biased to one pathway than the other. They have to give equal importance to all 3. So you have to choose based on your area of interest. And having said that, how much of a change is that going to have on your career? Not much. It's just 7 readings. Just 7 readings. And if you really want to learn the others, you can. So from our perspective, what we do is we actually give you the videos for all 3. We give you the video recorded sessions for all 3. Now you choose which video you want to watch. And if you want to watch the others, you're welcome. So you're actually be able to get the exposure to the others also. All right. Any questions now? Anything more? If there are no questions, then I'll probably start with the content right away. So any questions, queries about the course, content, classes, material, preparation strategy, anything that you think you want to discuss at the moment? So what we'll be doing is that once you have, registered for the sessions, we'll add you to the relevant WhatsApp group for the August exam. And I'll share the past year papers, the tests, whatever we have, and then we'll take it from there as well. Okay. Yes, by the way, towards the end of the classes around July, we'll also have paper discussion classes. A paper discussion class means that what we'll do is we'll give you the paper, a mock paper, ask you to attempt that paper. And after you attempted that paper, we'll have a class and we'll discuss what is the right way to have written that. What is the right way to have attempted that? Multiple choice questions is not a problem. But as far as the written section is concerned, what could you have written? So I won't go through checking individual answers for each one of you, no, but we can discuss as to if you had written this or if you had written something else, what is the kind of marks that you could have got. I'll show you my answers, what I wrote for that, and I'll compare that with the actual sample answers being provided, and I'll give you an idea as to how to score that. Okay, so I'll give you an idea as to how to score those answers. Fair? Anything else? Any questions that come to your mind? Are you all okay? All right. If there are no questions, in that case, we start with our first class today and the first topic, which is on capital market expectations. Now, capital market expectations, which is the first topic in the CFA Level 3 content, is actually a topic on ethics. Sorry, is actually a topic on economics. Is actually a topic on economics. But before I start with this, I want to tell you about how the Level 3 course is structured. So let me introduce the Level 3 course of how the Level 3 content is actually divided and structured for you. This is a diagram that I will draw, which is very similar to something that I've drawn at Level 1 for you in the portfolio management class. And here we first talk about that you start with creating an IPS for the client. And on the other side, you structure what is called as the capital market expectations. The IPS, investment policy statement for the client, is the long-term goals of the client, financially what he wishes to achieve, his financial goals, his risk return requirements, his constraints, everything is mentioned in the IPS document. How will we manage his money? What are the objectives of the money management? Parallelly, we construct the long-term forecast for the markets, which help us to understand the kind of returns that different asset classes can potentially provide us. So in capital market expectations, we are looking at the structural important factors in the economy and the business cycle that can help us to understand where we are in the economy, and therefore what are the forecasts for the potential returns and the potential behavior of the asset classes and the economy in the future for 5, 10, 15, 20, 25 years. So in simple words, these are long-term economic forecast and these are long-term goals of the client. We connect the two and get to what is called as the strategic asset allocation, which is the policy portfolio for the client, which is what the client would be advised to hold in the long run. This is what the advisor would advise the client and say, sir, this is where this will help you meet your financial goals. If you are able to stick to this, we should be okay. Then the next step comes about is called as the stage of implementation. So we implement the plan. And after we implement the plan, we look at the performance evaluation. We measure the performance. So performance evaluation. We review. We rebalance. And once we've done all of that, we go back to the initial step again, which is to say that portfolio management is not a one-step thing that is done. It is a process. Now, looking at this diagram, you can actually see the entire CFA Level 3 course. Have a look. At the top, you will notice is capital market expectations, that is learning module 1 and 2. Then you come to asset allocation 3, 4, and 5. That's the first book. Within asset allocation, you talk about which asset classes. That is LM 1, 2, 3, 4, 5 in the second book. So 1 to 3, sorry, 1 to 3. The first 3 learning modules in the second book in under portfolio construction is the asset classes. Learning module number 4 and 5 in the portfolio construction part go into the part of IPS, formulating the investment policy statement for the individual and for the institutional. Learning module number 6 is into implementation, the trading cost and electronic markets. Next is performance measurement, which is the last stage at the bottom, where you look at the performance evaluation, manager selection, and overview of GIPS. GIPS is something that you will go do in detail now. A lot more in detail as compared to what you did at level 1. Level 1 was just an introduction to that. And you might now wonder, where is derivatives in that entire picture? So in the entire diagram, where is derivatives? Derivatives comes here. And derivatives comes in here at the part of what we call as tactical asset allocation. Tactical asset allocation refers to short-term deviations in the market or short-term deviations from the strategic asset allocation policy portfolio that help you to capitalize on the opportunities that tend to rise in the market in case the markets don't behave the way you expected them to. Say, for example, if you're holding a $1 billion portfolio and you believe that the markets are overvalued, you can't sell your $1 billion portfolio and sit in cash. You can't do that. You yourself will move the market. So how do you alter your asset allocation in the short run without having to sell your entire portfolio and without having to incur massive taxes, transaction cost? You use derivatives. So we will read about the various strategies that you can use using derivatives, options, swaps, forwards, futures for your fixed income asset class, for your equity asset class, for different asset classes to alter your risk exposures. And that's where derivatives come in. And finally, if you are an international portfolio manager, currency management. So if you see, this one diagram summarizes this entire core area of your readings. Frankly speaking, this was this one diagram was actually the entire CFA Level 3 content till they introduced the pathways. Because portfolio management pathway is the original pathway. And here we used to talk about asset classes. So it is, in the case of portfolio management, we just talk about details of equity, debt, and finally, trade execution, which is also again a part of implementation. So frankly speaking, this is your area, or this diagram is one you can come back to if you're feeling lost in the course, which will happen, by the way, which will happen because the way the level 3 course is structured, you are bound to feel lost. Sorry, that's how it is. Level 3 course is going to make you, feel a little bored and dried sometimes. So that's the base that you have to think about from the level 3. So whenever you're feeling that, oh, what am I covering at level 3? This is what you're covering. Capital market expectations has 2 chapters, CME part 1 and CME part 2. Part 1 talks about macroeconomic forecasts. Forecast for the economy, forecast for the business cycle, monetary fiscal policy, yield curve shape, relationship of the yield curve with for fiscal policy, monetary policy, business cycles, using economic indicators to forecast, different approach to forecast for economic variables, So if I were to say this part 1 of the chapter focuses on the macroeconomic part, part 2 focuses on asset classes individually. I'll show you. Part 2 focuses specifically on forecasting for fixed income, forecasting for equity, forecasting for alternative investments, real estate, forex, volatility. How do you forecast for each of those asset classes? Okay. So that's how these two chapters are divided in each other. So the base of these two chapters is to be able to think about how to forecast for the future. And that's what it starts with. It says that the fundamental law of investing is the uncertainty about the future. The fact is that you don't know what's going to happen, but you have no choice but to forecast. You can't just look at the history and say, no, I will look at the historical data and do it. No, it doesn't work that way, because your investment decisions are about the future. So you will have to think about the future. Yes, and we understand that the future is uncertain. So therefore, you will not be correct all the time. And I read one line in the CFA program many years ago. And it's one of the most powerful lines I read. And it said, if I divide the return of the portfolio into various components and try to understand why is the portfolio return being generated. So if I divide the portfolio return into asset allocation, security selection, market timing, the primary reason for asset return generation was the first factor, which is asset allocation. Around 75 to 80%, or maybe around 90% of the portfolio return is being explained because of asset allocation. And that's the primary determinant. So which means it's not about individually which stock you bought. It's not about individually which security individually you purchase. It's about how much you invested in equity and how much you invested in bonds, how much you invested in real estate. That decided your fate of the performance of the asset class, of the portfolio. So capital market expectations are about trying to forecast for the macro variables, which helps us form the base for our strategic asset allocation, which is the policy portfolio that we make. These forecasts about the future should ideally be unbiased, objective, and well researched, so that the error that you have in the data possibly can be minimized. And there are about 7 steps that we can follow in the process of forecasting. And these 7 steps entail specifying the set of expectations that you need. What variables are you wanting to forecast? How far ahead in the time frame that you look for? For each of those variables that you wish to forecast, you would tend to research those variables and look at their historical performance. Then you'll think about identifying the valuation model, the method that you would use to forecast them, determine the best source of information that is needed, and look at this very interesting point, 5.5. I find this very interesting, which says that your idea of forecasting is not just to look at the numbers, but very often forecasting involves experience and judgment too. So it's not just about making a model and putting it there. Forecasting very often entails experience, judgment. Then you formulate the capital market expectations with reasons, assumptions, whatever reasoning you've provided, and then you monitor the outcomes and see if things are coming out the way you had expected them to be. And if not, you improve upon your expectation setting process. So this entire game of forecasting is a learning process. And as you learn, your forecasts get better. But forecasting the future isn't that easy, because there are many problems that you tend to find. For example, there is limitations of economic data. There is a time lag with which the data is often collected, processed, and disseminated. By the time, for example, you get the GDP data also, it's almost about 2 months late. For example, if you see You want to forecast what's going to expected to be happening 10 years later. You want, let's say, the GDP data right now of, let's say, this quarter, Jan, Feb, March. The GDP data for ending March will come somewhere in end of April, May. And what if that data has problem? Because what if the data collected, processed by the institution has mistakes in it? Very often the data gets revised. Data has survivorship bias. Survivorship bias means that the data being collected is only from those firms, those companies which are now there. The companies that shut down, the companies that are no longer there, you don't get to see data for that. So you always have an upwardly biased data set. Also, you might sometimes feel comforted by using long-term data, where you may use data for a long period and say, oh, the data for the long period is probably going to be good, but that may not be comparable because data may not be comparable for the past. You may find that the previous long-term historical data may not be comparable to the data today. And the reason for that is that there could be a change in the regime. A regime change means that the structural relationship may have changed. So historical long-term data is not necessarily always a good thing to look at. Another very interesting point that comes out with historical data is that history happened only in one way, not necessarily the most probable way. मतलब अगर हम historical data देखें तो हमें सिर्फ एक ही आउटकम दिखा, बट उस टाइम पे जरूरी नहीं कि जो आउटकम सबसे प्रोबेबल था वही हुआ. बहुत बार ऐसी चीजें भी होती हैं जो प्रोबेबल नहीं थी, और अगर फिर से हिस्ट्री को रन किया जाए तो शायद लाइफ वैसी ना हो, शायद सिचुएशंस बहुत डिफरेंट हो. और काफी बार ऐसा भी होता है कि मार्केट में काफी चीजें एक्सपेक्टेड थी होने के लिए, बट वो हुई ही नहीं. तो बाय चांस आपने अगर हिस्टोरिकल डेटा देखा और उस हिस्टोरिकल डेटा में एक बहुत खराब इवेंट एक्सपेक्टेड था, बट वो नहीं हुआ, तो अब आपको क्या लगेगा कि मार्केट कैसे बिहेव की? तो मार्केट में वो गिर रही थी, बहुत एक खराब एक्सपेक्टेड इवेंट था, बट वो खराब इवेंट हुआ नहीं, तो उसके बाद बाउंस बैक इतना स्ट्रांग हुआ और आपको कभी वो इवेंट के बारे में दिखाई नहीं दिया कि वो हुआ, तो आपको लगेगा अरे मार्केट अंडर वैल्यूड थी, आपको लगेगा कि मार्केट्स ये ऐसे क्यों बिहेव कर रही थी. Whereas on the other side, you might actually not know that bad event that did not happen, उसका information, उसका data है ही नहीं कहीं पर. So looking backward, we are likely to underestimate the risk because the events, the negative events that did not happen are not there in the historical data set. Then of course there are biases in the data and the patterns that you tend to derive out of that. Data mining bias. Data mining bias means that you look at the data and you discover patterns, but those patterns don't have economic meaning to them. So data mining bias is a bias where the data is showing you a pattern, but that pattern doesn't exist in economic terms. It just is there by chance. Because every data pattern doesn't have to be necessarily logical. Point number 6 talks about the fact that there could be conditional information. Conditional information means that information was dependent on the occurrence of some event. Okay, if this happens, then that will happen. It was not absolute. So unconditional forecasting may not capture the true picture. So you can't just average out the forecasts. Sometimes the occurrence of an event is dependent on the occurrence of other events. Only if they happen will the other event happen. But if you average them out, you might tend to overestimate their probability. So failure to account for conditional situations, that events are likely only when they are preceded by a certain another event. Also, correlations can be misinterpreted. For example, if X and Y we find that are related to each other, that doesn't mean that if X was to happen, Y will happen, or if Y was to happen, X will happen. It's possible that a high correlation between X and Y could be because of simply they are correlated, but there is no economic meaning to it. Or it could be a case where X is driving Y or Y is driving X, or maybe Z is driving X and Y. So misinterpretation of correlations is always possible because we don't know which variable may be endogenous and which is exogenous, which is the dependent, which is the independent variable. Correlations also don't necessarily measure the relationship beyond the linearity of the relationships. And then, of course, model uncertainty. We use so many different models to estimate our data, but the models may not be accurate. And let's not forget the fact that we are humans and we make mistakes. And as analysts, there are many biases in our own way of thinking. For example, anchoring bias. Anchoring bias means that we give very high importance to the information that comes first.
So can you go back to the slide on the smoothing of data? Let's have a question.
Now, बताएं.
Sir, I have a question regarding correlation. So why do the correlations get understated when the data is like smoothened for the liquid asset classes?
Why does the correlation get underestimated when the data is smoothened? For example, let's say we look at the real estate market. Real estate prices don't change every day because you don't get to see them transacting very often. You don't see the transactions happening every day. And because you don't see the transactions happening every day, now you have a data set which is on Excel. Imagine you have a column of data which is not changing. And you have another column of data, let's say the stock market, Sensex, changing every day. Now, if you run a correlation of that data, you will find the correlation to be low, almost zero maybe, because one's not changing and the other is changing. This would have to be adjusted for because the volatility that you see in the real estate, the volatility that you see in the stock market is not even visible in the real estate market. So smoothing tends to make the correlation appear to be lesser. They aren't as low otherwise, though. Does that make sense?
Yeah, understood. Basically, what is happening is that the appraisals are happening at very, let's say, quarterly or let's say monthly. So the
True.
data doesn't get reflected in that.
The data does not get updated. Transaction नहीं हो रही. और ये प्रॉब्लम आपको हर प्राइवेट एसेट में होगी, चाहे वो रियल एस्टेट हो, चाहे प्राइवेट एसेट्स हो, चाहे हेज फंड्स हो. कोई भी प्राइवेट एसेट में ट्रेडिंग नहीं हो रही है, तो अगर ट्रेडिंग नहीं हो रही है तो आपको उसका रियल टाइम डेटा नहीं मिल रहा है. और आप अगर उसको किसी भी ऐसे एसेट के साथ कंपेयर करोगे जिसका प्राइस रोज चेंज करता है, तो उसमें कोरिलेशन कम नजर आएगा. कम कोरिलेशन की वजह से उसका रिस्क कम फील होगा. डाइवर्सिफिकेशन बेनिफिट्स आपको उस एसेट में से ज्यादा फील होंगे और आप उस एसेट को में ज्यादा इन्वेस्ट कर दोगे. और ऐसे एसेट्स यूजुअली इलिक्विड होते हैं. तो अगर हम सिंपली मॉडल के डेटा के थ्रू जाएं तो हम लोग फंस जाएंगे, क्योंकि हमारा उस एसेट में ओवर एलोकेशन हो जाएगा. Does that make sense?
Sure, sir, understood.
All right. Moving to the kind of psychological traps that we could potentially have in forecasting. We as also analysts are human, so we end up giving too much of weightage to the first information that comes our way. So there are situations of anchoring bias where we disproportionately weight the first information too much. Status quo bias is where we have a tendency not to change our original forecast. So if we have made a forecast, we don't want to change that. Status quo bias is more like a laziness bias. A laziness means that I am unwilling to move. The new information comes, I am just not willing to make that change. Doing nothing. Stay where you are. Confirmation bias is something very, very, very common in the financial markets among investors. And this is where we look at what is called as seeking out opinions of those who think like you. तो मार्केट में अगर आपको दो लोग ऐसे लोग मिल गए जो आपकी बात ही कह रहे हैं, जो आपने सोचा था वैसे ही कह रहे हैं, तो आपको वो सुन के बहुत कॉन्फिडेंस मिलता है कि अरे जो बाकी कह रहे हैं वही मैं सोच रहा हूं, तो शायद मैं सही ही हूं. So tendency to seek and overweight the information that is in line with your original thought. And overconfidence simply means that you have unwarranted confidence on your intuitive reasoning, knowledge, judgment, or ability. You ignore the past mistakes and you repeat the same ones again and again. Prudence bias is an interesting one. As somebody once said that if you make a mistake, better be in a group, because the punishment in that case will be lesser. But if you are singled out, then the mistake will be much larger. So to avoid regret, analysts avoid making extreme forecast. They try to remain close to the average. And that means that you never stick your neck out. And the chances of that is that you probably don't take extreme calls ever. And the last one is availability bias. I call it the recallability bias, or the bias where you say, I still remember. In which case you say that, oh, this is expected to happen because, yes, I experienced it. The past disasters or dramatic events that you have experienced weigh too heavily on your forecast. So your experience, your personal experience, weighs on your forecast too much. These are psychological traps that tend to happen and influence your forecast significantly. Okay? Now, that's the very basic part of this topic, just a starting point. The core part of the content starts from here, frankly, which is that if I wish to forecast about the economic future, there are two aspects that I want to look at. One is the structural component and one is the cyclical component. When we talk about economic growth is driven by two factors. One is the structural factors and one is the cyclical factors. The structural factors are factors such as increase in labor force, increase in capital, increase in technology. Whereas cyclical component refers to the business cycle. So what drives economic growth in the long run? The economic growth is driven by labor, capital, technology. Now, trend component looks at the long-term forecast of labor supply, labor productivity, and within the labor productivity, we talk about capital and technology. So if you remember the subject that you studied in level 2 economics, economic growth theories, where we said that economic growth is driven by three factors: labor, capital, technology, right? And on the other side, we talk about business cycle, which is the short-term deviations of the economic forecasting versus its long-term trend. So the growth may be higher or lower than its trend growth rate. All of them can further be impacted by the government policy by focusing on infra, fiscal and tax policy, promoting competition and minimal intrusion with the private sector. Those things can tend to have a structural impact on the economic growth in the long run. So what we'll do is our focus will mostly be in the area of the cyclical part of this chapter. So we'll focus on the cyclical part and understand how that gets driven. But however good the forecast that you might make, you will notice that the forecast will very often be impacted by exogenous shocks. Exogenous shocks are things that happen out of the blue, completely impossible to forecast. They tend to come in absolutely unexpected. These could be natural disasters, some political events that are not factored into the asset prices. An economy that experiences the exogenous shock will eventually return to its long-term average, but the impact of this shock can be prolonged, can take time. Exogenous shocks typically arise from the outside of the system, like changes in government, technological changes, natural disasters. Oil price shock is a good example that may have happened in the past many times. Financial crisis, or in the recent age, the technological change that's happening. All of those are exogenous shocks that happen to the system, completely unexpected. You don't know where it's coming from and how long will the impact of it last. These changes, these aspects can make your economic growth forecast be questioned. But the point, as we said, that your economic growth forecast comes back usually to the long-term average, but it may take time to get there. This is one of my favorite topics and slides in the entire content, which tells us that economic growth is anchored. Economic growth is the anchor for your appreciation and performance of your equity market. You may have heard this very often, where people say that the return that you can potentially earn out of the equity market in the Indian market is an average of 12 to 15%. So if you look at the return on the Indian market for the last 15, 20 years, it will be approximately around 12 to 15% CAGR. Now, where does this number come from? The 12 to 15% CAGR is actually the performance of your Indian GDP growth rate. Yes. So what I was saying was that we will take the economic growth and we will divide that into the cyclical component, the trend component. Our major focus will be here on the cyclical component though. The trend factor is driven mainly by three variables: labor, capital, technology. And I mentioned to you that you would have heard in the past that if the economic growth of the Indian market is around 12 to 15%, the nominal growth rate, which is the 6-7% real growth rate that you see, plus the inflation of the similar number, you'll find that the return on the Indian market has also been the same in that time period. If you look at this equation, on the slide, it tells you that the movement in the market, which is the price, can be influenced by three factors: GDP, E by GDP, and P by E. E by GDP refers to the proportion of the corporate earnings in the market as a whole. So if you think of GDP as a comprises of consumption, investment, government expenditure, export, import. So what is the proportion of the corporate earnings in that? Now, this cannot be a sustainable factor which keeps going up. Neither is the P ratio, which is a trending variable, which is not. It is not a trending variable. It's a mean reverting variable. So the primary driver of prices has to be economic growth. Now, while that sounds very amazing as a concept and brilliant as a point, but let me also provide you a very contrasting result. Look at the contrasting result that you get in case of China and Japan. In case of China, you will find that the economic growth in China has been unbelievable in the last 20 years. You might actually be surprised to know that the GDP of India and China was almost equal till 1993. Till about 1993 or so, India's and China's GDP was almost equal. But the kind of spectacular rise that China has had in the last 30 years is unbelievable. From being almost a $500 billion economy to being a $20 trillion economy, their growth has been spectacular. But now contrasting that with the stock market performance, look at the stock market performance of China. It's not done as well. It's fascinating how they have not, their stock market hasn't moved as much. But if you look at the performance of Japan, now Japan's economic growth has been rather stagnant. They haven't grown much in the last 20-25 years. Whereas the stock market has done fantabulously well. So while this slide provides some sense of very interesting idea that, oh, price movement and GDP growth rate are hand in hand, but that doesn't always translate into reality. Okay? So recognize that part. This example number 8 here is very interesting to note here. So let's work through that on this point. So let's read through this. It says in January 2000, this guy was updating the firm's projections of US equity returns. And the firm had always used historical average return with very little adjustment. He was aware that the historical averages are subject to the large sampling errors and was especially concerned about this fact because the sequence of high returns in the late 1990s, as well as the past few years, partly due to the very low interest rates during that period. She decided to examine whether the US market returns since the World War II have been consistent with the economic growth or not. So that means a period from 1946 to 2020. And the growth rate continuous compounded return came out to be 10.7%. This was broken down into its components. The 10.7% return, annual return, was broken down into the components where the return was coming from real GDP growth rate to be 2.9%, inflation 3.5%, EPS to GDP, earnings to GDP as a fraction being around 0%, P ratio of 0.9% growth rate per annum, and 3.4% dividend yield. Now, what conclusion was this person willing to draw out of that? Now, which of these factors are sustainable? Is real growth rate sustainable? Yes. Inflation sustainable. E by GDP is anyway 0, so nothing much on that. Dividend yield sustainable, but 0.9% of PE change every year for a 74-year period, that actually can be a massive point. So that may sound like a very small number, but that's 0.9% per annum for 74 years. That can actually add up to almost like a 70% return over that period. Can the P ratio expand like that forever? No, it cannot. It cannot be a sustainable factor. So if she believed that in the long run, the US labor input would grow at 0.9% and the labor productivity by 1.5%, and the inflation would be 2.1%, the dividend yield this much, these would be her long-term forecasts. So you simply add that up and say, this is the baseline forecast. So the baseline forecast would include only the key variables which are sustainable, and P ratio is not one of them. All right. Now comes a very interesting part of how to forecast the future. What are the different ways to look at? So there are three models that are approached, or the three approaches which are suggested here: the econometric model, the economic indicators, and the checklist approach. The econometric models are something that you have seen at level 2 in the quant area. The econometric models are where you look at the relationships, model them by using the quant equations. So these are now quantitative models used to estimate the precise relationship between the dependent and the independent variables and to formulate equations out of that. And once you formulated the equation using robust data and the economic theory, then you can use them to forecast the future. The strength of such models are they can be used easily, the ability to model complex real-world conditions through quant, and provide you precise quantitative forecasts as well. But the weakness of these models are that they are using historical data, so they may not be reliable if relationships are expected to change, because relationships are not static. Relationships change over time. And as we have discussed in CFA level 2, one of the limitations of quant is that the model can be misspecified. The assumptions can be violated. And if the assumptions are violated, the output and the conclusions that you're drawing are probably not appropriate. They may be biased. And having a very precise forecast about the future gives you a false sense of accuracy कि भाई future में ऐसा ही होगा, which is obviously not the case. You make narrower confidence intervals. So it's better to look at the econometric models along with other methods of forecasting. And economic indicators is one of them. What are economic indicators? Economic indicators are those indicators that you have seen at level 1 in economics, which are labeled as leading, lagging, coincidental indicators. These indicators give you an idea about the future that's going to happen. Coincidental indicators give you an idea about what is currently happening, and lagging indicators give you a confirmation about the past. These economic indicators are available to almost everybody in the market, and you can derive an idea about their relationships and see how things are expected to work in the future. So these are economic statistics released by official agencies and contain information about the economy. Summarizing these economic indicators, you can use something called what is the diffusion index. A diffusion index is like a collection of lots of indicators together into one variable, which helps you to forecast and see what part of the indicators are moving in line with the current scenario. The strength of the economic indicators is that it's very intuitive and simple. It focuses on identifying the turning points in the market and are easy to track. They are available for almost everybody. But that's also the drawback, because there is no extra value add that you have, because this information is public to everybody. One of the biggest problems of economic indicators is that they can give you false signals, because economic indicators is not pure science. So they can give you false signals too. And there is look ahead bias. Look ahead bias in case of data means that you look at the past and you use data that was not available on the test date. लुक एट बायस का मतलब होता है कि आप हिस्ट्री में देख के सोचते हैं कि उस रेशियो को, उस वैल्यू को हम इस्तेमाल कर सकते हैं, बट वो डेटा उस टाइम पे अवेलेबल नहीं था. तो फॉर एग्जांपल जैसे कि जीडीपी का डेटा है, तो वो 2 महीने 1.5 महीने लेट आता है. बट से फॉर एग्जांपल यही डेटा जब हम बाद में देखते हैं तो हम ये अज्यूम नहीं करते हैं कि डेटा बाद में आया था. We look at the data for that period itself. But in reality, people don't have this information available at that date. This information is not there. The data comes out with a lag. So economic indicators has a downside of the point of having a look ahead bias. So third way of thinking of forecasting is called as what is called as checklist approach. In a checklist approach, what we do is we look at an eclectic approach. Eclectic का मतलब होता है कि आप बहुत सारी different चीजें देखते हैं. There is nothing specific that you are forecasting. For example, you ask a set of CEOs that what are your concerns at the moment? What are the variables that you are thinking of at the moment? And from there you collect the variables that are relevant, and then you try to model those. So an eclectic approach using wide variety of sources to derive the conclusions. This entails answering questions that relate to the future growth, help to make fair judgment and give a direction as well. I'll share a document with you on your WhatsApp which gives you an idea of what a checklist approach could be. To show this as an example, let's have a look at this. Maybe this will help you to understand better. Example number 9. This question will help you to understand the topic a little better on these 3 approaches to forecast. So look at this question here. It says Sarah and Adam are members of the asset allocation committee at Cycle Point Advisors, which emphasizes the business cycle within its tactical asset allocation process. Burke has developed a time series model of the business cycle and uses the published LEI series as a key input. LEI refers to the indicators, economic indicators. He presents forecasts based on the model at each asset allocation meeting. Isaac, however, uses an eclectic approach, preferring to sample research from a wide range of variety of sources each month, and then focuses on whatever perspectives and results seem most interesting. She usually brings a stack of charts she has copied to the asset allocation meeting. Okay. So now, thinking about that, if you look at the first question, it says, which main approach, forecasting approach, is each of the analysts using? Now, in this case, it's quite obvious that the first guy, Burke, is using an econometric modeling because he's using time series. But he's also using the leading indicators. So Burke is using a mixture of two things, econometric models and the indicator approach, the economic indicator approach. Whereas Isaac, on the other side, is focusing on a checklist approach. What are the strengths? What strengths are likely to have appealed to each analyst for this so and so forth in terms of the approach being followed? Burke is attracted probably to the quantitative output provided by the model, because the econometric model will provide you a quantitative output. He may have included the LEI in the model because it is designed to capture the cyclical turning points, or simply because doing so improves the model's statistical fit. Isaac, on the other side, draws on the flexibility of the checklist approach. See, checklist, as I mentioned to you, what it does is you take ideas, style from a variety and a broad range of sources. That's what the checklist approach is, that you're looking at many different things. मतलब आप कोई specific area नहीं देख रहे हैं, तो different चीजें forecast करते हैं, अलग-अलग चीजें देखते हैं हर बार. That's the checklist approach. So the strength of that approach is that it is, it has very little complexity. It is flexible, but the weakness is very arbitrary, subjective, time consuming also, manual process, limits the depth of analysis. And there's no consistency in your forecast. आप अपने पिछले मीटिंग में कुछ और देखा था, अब आप किसी और एरिया पे फोकस कर रहे हैं. So there are the different ways of potentially forecasting. What are the weakness of each of these models and what they may be overlooking? So Burke may be overlooking the potential misspecification of the model. The first model that we talked about, the problem could be misspecification. Data could be biased. There could be regime changes. Whereas in the checklist approach, the problem is about what may seem interesting currently may not be as interesting a week or 2 weeks later. So things may change. So it seems like more like, following the trend. A checklist approach seems like that. Is this all making sense? Any questions at this stage? Any query, question, anything that's coming to your mind, guys? I know it's a little dry. The first chapter specifically is the driest of all, but that's how the content is at level 3 for at least some part. The remaining part of the content is a little more interesting, but this one definitely is the drier part of it.
So actually, I have a question.
Yes, go ahead.
So can we say in the checklist approach, we are having the confirmation bias? Let's say the analyst has some view, and to confirm it, he's using certain factors which like appeal to his view.
Could be. Why not? Yes.
And in the econometric approach, it is the overconfidence bias that
can ultimately happen because of the precision that you have in forecasting. Yes.
Okay.
Yes.
For the look ahead bias in the you can say the LEI approach. So it is like let's say for a company you're forecasting the, let's say, the price. So we are using the financial statements and the you can say the profit and all of that. So basically in India we receive it on 31st of March 20 of the year, but actually they are available 1 or 2 months later after that. So that is also part of look ahead bias.
Yes. So getting the data a lot later than the date that you think the data would have been available on. So because the data is available a lot later, today it's not a problem, but looking back at history, you assume that the data was available on the test date, which is what look-ahead bias is. Okay. Talking about the next segment, and I'll just probably introduce this topic today to you on business cycles, and we can probably continue on this on the next week, because I don't want it to be a bombardment of content to you on the first day. The part on business cycle, what is it? What are the various stages? And how does every asset class perform in each of these phases? And the role of inflation in each of these phases is something that is very critical to understand. Within that segment, we'll also talk about the impact of monetary fiscal policy, the shape of the yield curve, and then finally we talk about the macroeconomic linkages across different economies. So that's the segment of this topic that's left out, and we'll definitely complete it in the next session. But just to introduce you in the last 5-7 minutes of the class today, what is a business cycle? It's not a well-defined cycle, but it generally contains of 5 different phases. And business cycles are the result of many intermediate fluctuations that jointly generate the most variations around the trend. What happens in a business cycle is that the economic growth doesn't happen in a linear fashion. Very often the economic growth happens sometimes faster and sometimes slower than the trend, or sometimes even negative, while the trend growth rate remains positive. And the reason for that happens is mainly because of the inability of the businesses to forecast the futuristic demand. Business cycles arise because you have expectational errors. As businesses, you don't know what to produce and what will be purchased. And capital investment decisions cannot be changed so quickly. There are rigidities in your investment decisions. And once you've made those investment decisions, you cannot undo them in the short run. It takes time for you to realize what's happening in the market. And you are not the only one doing so. There are lots of people taking that so simultaneous decisions at the same time. It reflects that, the business cycle reflects that, these are decisions being made on imperfect information about the future. We don't know exactly what's the demand like. And all of these investments require massive amount of expenditure. For example, let's take the case of the auto industry today. Maruti, for example, has made a massive expenditure for building new plants to produce new cars, EV cars, that will probably hit the market in about another 3-4 years. They have to decide today the kind of demand that their cars will have few years from today. Isn't it? Think of that. They have to think about the model. They have to think about the kind of preferences. Everything has to be planned out today. Now, you don't know 2 years ahead which car are you going to buy, but they seem to have that plan in place. And if those plans don't work out, all the expenditures that they would have made would be all in the waste. Those are the reasons why business cycles occur. It is the inability to perfectly forecast the future. And all those expenditures require significant amount of resources. And these decisions are, once taken, are difficult to reverse. So predictions about the phase and the turning points of the business cycle are also difficult. In fact, it's very difficult to even know which phase of the business cycle are we in right now, because this is not pure science. While we can, in theory, talk about the characteristic of each phase, but when they actually happen in the real world, they don't happen precisely in the way that we read them in the textbook. And one of the reasons why it is difficult to assess that is because it's very difficult to assess why is the economy currently behaving the way it is. Is it because of a cyclical factor or is it a structural factor? Like, take an example, you currently see the IT sector facing a significant problem. AI seems to be causing significant challenges to them. Is that a trend issue or is that a cyclical issue? Is that a short-term issue which will correct itself over time? Or is that a secular trend issue on the entire sector? Don't know, hard to say. Also, the correlation or the connection between the real economy and the capital market is strong, but it's not always certain. It is subject to substantial uncertainty. As I mentioned to you, that the Chinese economy has gone almost 40 times in 30 years. Whereas the equity market hasn't. The Chinese equity market hasn't kind of performed the way that the economy has. So while the connections between the real economy and the GDP growth rate and the stock market is strong, but it's not always there. Returns over substantially shorter horizons are likely to be driven by market reactions to more transitory developments, undermining the cycle's predictive power, therefore. On the other hand, as the forecast horizon becomes longer, it becomes increasingly likely that a turning point will likely occur within the horizon or a structural change will happen within the horizon. So in simple words, what we are trying to say in this slide are two things. First, why are business cycles happening? Second, it's very difficult to forecast the phase you are in and the turning points of the cycle. Despite that, I go back to the first line that I mentioned today in our class, which is forecasting is difficult, but you have no choice but to do so because all investing relates to the future, right? This is a logical point to stop for the day today. We'll have our sessions for 2 hours. We started at 6 today with the first hour introduction and then an hour of discussion. But for the next class, what we'll do is we'll cover out this entire chapter and also look at the chapter number 2. So hopefully by the coming weekend on the next week, which is when we'll really start out the classes with you guys, 21st and 22nd, the next weekend, I will most probably cover out all of capital market expectations and even probably start out with the asset allocation chapter with you. Okay. Any questions before we stop for today? Anything that you would like to discuss, ask, or anything that might have come up that you would like to talk about before we stop? All right. If no questions, then in that case, guys, we stop today. And I'll see you guys next weekend on Saturday. And if you have any questions, you can always WhatsApp on the group and we'll be in touch soon. All right. Thank you. Have a good day. Have a good evening.
Thank you.
Bye-bye.